Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask is that you hit thumbs up and subscribe. I mentioned last week that on June 5th, there is a real estate event with North Cove Advisors, Ben Rabideau. If you don't know Ben, he basically provides Canadian real estate and credit market analysis to hedge funds across North America. Extremely smart guy, good friend of mine, and he'll be doing an event here June 5th in Vancouver. So if anyone wants to go to that, I've actually been given some free tickets, so I have a couple more to give away. I've obviously been giving some out to friends and clients and that sort of thing. But it'll be a really good event if you want to come here, come out and socialize, etc. I'm giving away 2 tickets to that event, and so if you want those tickets, just comment below and tell me why you want them or who you whatever, and I'll just pick a couple of people at random. Like I said, I got 2 tickets to give away, so if you want to go to that, just put that in the comments below. Basically want to dive into the Vancouver market stats for the month of May. I have some preliminary numbers on that. I'm still waiting from some of the real estate board statistics, but obviously I run a lot of my own analysis, so I've got some of those tidbits for you, and then I'm going to get back into sort of the bigger picture and tie everything all together once again. So, as always, there's everyone might have slightly different opinions and views on each varying market. Again, I try to look at really overall bigger thesis. So if we're looking at the Vancouver Detached housing market, as I've mentioned, Q1, so 3 months worth of sale, Q1 record a 30-year low in detached sales. That same thing continued in April, and the same thing has happened again in May. So there was my data goes back to 1991. So for this May of 2018, detached sales came in at their lowest total in 30 years for the month of May. And that resulted in a 39% decline on a year-over-year basis. So if you take May 2018 versus May of 2017, there was a 39% decline in detached sales, and like I said, this was the lowest total dating back to all the data that I have, which goes back to 1991. So I mean, again, you can try to sort of mop that over and say it's nothing and people can justify it, but at the end of the day, I think a 30-year low in sales really speaks for itself. So we'll get into more of sort of inventory and new listing numbers and sale prices, all that in another video. Once more of that data, I have time to sort of analyze it. But if we switch over to the condo market, as I said, it seems like we are starting to turn a corner. Obviously, the April numbers were quite weak in terms of sales numbers and volume. And then here we are in May. So if you're looking at May 2018 versus May 2017, May was obviously a very strong year, but sales declined by 28% on a year-over-year basis. So that slowdown is starting to shift into the condo market. This actually brought us down to a 5-year low for the month of May for Vancouver condo sales. And that same thing happened in April, right? We had a 5-year low in April. We had a 5-year low again here in May. As I mentioned, in the city of Vancouver anyways, which I think is really where things sort of start and then they spread out. City of Vancouver, to me, the prices appear to have topped out. I mean, particularly in the 2-bedroom segment, anything that's starting to get more expensive right now, you're talking about typical 2-bedroom in the city of Vancouver getting close to $1 million, right? As those detached prices are coming down, and I think these mortgage rules are starting to bite as well, people just simply aren't willing to bid those prices up any higher. And so we're starting to see, I would say, flat prices in the Vancouver condo market over the last couple months. Obviously, we'll have to wait and see how that shapes up. The number of inventory for sale is still extremely low, but it has been rising over the last couple months, and that's partly because fewer and fewer sales are happening. We're starting to see some more new listings. And then obviously new construction, so that's allowing the inventory to build up as sales are simultaneously falling, and so that's relieving some of the price pressure, right? So yeah, I think in a lot of the 1-bedrooms, you're still seeing a lot of multiple offers happening, but as opposed to 5 or 6 offers, it's maybe 1 or 2, and if it's listed for 600, it usually goes for 600, maybe 605 versus, what we're seeing 4, 5, 6 months ago, and particularly even last year, right? These prices were getting bid up $30,000, $40,000, $50,000 over the asking price almost every single time, and those are just pushing prices up every single month, and we're just not seeing that in the condo market. So again, we'll dive into more of those numbers next week's videos. But I just basically wanted to give you a quick snippet preview. I know you won't be able to get any of that analysis anywhere else in terms of actually going back and looking at sales all the way back to the 90s, and then segmenting out all the other months and just looking at the particular months, so we get rid of some of that seasonality bias. Which really, again, brings me back to everything. I think people will get caught up in the micro. They go, well, yeah, sales are down, 30-year low, but what about prices, And ultimately, sales volumes lead prices. So as sales start to pick up, generally, depending on what stage of the real estate cycle you're in, if you're coming out of a downturn and sales start to pick up, generally prices start to trend up higher. Now, there's a little bit of caveat to that, but it's the same thing. As prices really start to go from a high to a new low, you can generally assume that prices are going to follow. But what happens is, again, it's a bit of a caveat, because you have to go through your real estate cycle. So in other words, if I can bring this back to previous example, yes, they're slightly different markets, but all real estate markets are cyclical, and they all basically function the exact same way. We'll look at Phoenix, for example, to really understand what's happening in the Vancouver detached housing market, and what I think is probably going to transpire into the condo market at some point. If you look at Phoenix during their housing boom of 2004 or 2003, really looking through the years all the way down into 2012 when they bottomed, real estate sales actually started declining from about 2005. I think they peaked in 2005. They started falling in 2006. They fell again in 2007, even lower, and then in 2008 they bottomed. They bottomed in 2008 as they hit the recession, and then sales actually started climbing up higher in 2009 through to 2012. And it wasn't, if you actually look at the Case-Shiller Index, which is equivalent to the MLS benchmark here in Greater Vancouver, the Case-Shiller Index actually basically went flat from about 2006 to 2008. It was basically flat. It dipped maybe a little bit. You wouldn't really, the average person looking at it would have said, well, prices aren't going down. And that was likely the case. Prices weren't really moving a whole lot, at least it appeared that way. It's only until you start to get basically like a clearance rate. You have to have basically sellers starting to slash prices because buyers aren't willing to pay those prices, right? There's fewer and fewer buyers, less sales, because sellers aren't willing to adjust their prices. Real estate is so sticky. It wasn't until sales picked up, aka sellers started slashing their prices, that the sales ramped up, the prices actually started falling. So real estate prices in Phoenix actually peaked in 2005, and they bottomed in 2012. That was like the bottom, and then of course they're basically right back up to their peaks today. So that's a typical cycle, right? You have to have those ups and downs. So I look at that as the Vancouver detached market. I mean, from peak to trough, the typical house in the city of Vancouver, I don't really care what's happening in Surrey or Abbotsford, because eventually what happens in Vancouver is going to transpire there. But peak to trough, the typical house is down about 10 to 15% in the city of Vancouver. And I would argue, we have a 30-year low in sales. I don't really think that this detached sales can go much lower. But I think it's if sellers want to see product to start moving, they're going to have to cut prices. And I think that's sort of where this leads to, right? I mean, we're still in an environment where people are willing to hold out. We still have an economy where we're seeing full employment. So there really isn't much reason to panic for these sellers, right? So everyone's sort of holding out for a better day. But I think that where we are in the cycle, and particularly where the Canadian economy is at, it's a very precarious situation moving forward. Of course, I've talked about how real estate is ultimately the economy. It is what drives economic growth. Obviously, there's been a huge emphasis on households to propel the economy moving forward. We've been on a massive real estate boom really since 2014, and the amount of workers that are now employed by basically the real estate sector or that have jobs tied to that is now, per Macquarie research, is now 2 standard deviations above its long-term average. So you have a lot of people that are concentrated in that construction sector. So anytime that starts to slow down, that's going to have a ripple effect through the economy. And you were starting to see that with some of the Canadian GDP data for Q1, which is just released earlier this week. So again, we look at national home sales for Q1, we're down 16%. There's clearly some slack. And you're starting to see that show up in the GDP numbers, right? So growth came in at 1.3%. That was below the 1.8% expected growth. Of course, who could have anticipated that? A slowdown in real estate is all of a sudden slowing our economic growth. What else? Real estate investment, residential investment declined on an annual basis, an annualized pace of 1.9%. So it's an annualized pace. And that was mostly caused by a drop in property transfer dollars, which declined by 13.5%. And furthermore, real estate broker output, so that's basically people transacting, whether you're leasing or selling or whatever, on a seasonally adjusted annualized rate, declined by 44.9%. So that's basically looking at the first Q1, projecting that out to an annual basis. They have it down by 44.9%. So that sector is getting hit. And of course, that's going to happen, right? As sales decline here in Vancouver, sales declining by 30%. That's less revenue for realtors. That is less revenue for mortgage brokers, lawyers, people consuming in the economy. Obviously, that ripples through the construction, right? As real estate starts to slow, maybe you hold off on that renovation. So that also comes into the trades aspect as well. A lot of developers are pushing through supply right now. I know of them. They aren't purchasing, most of the big guys aren't purchasing land today. They sort of know where the cycle's at. I mean, you don't get to how big you are and how wealthy you are without understanding a real estate cycle. So if you actually sit down with these guys, there's a reason why a lot of them aren't buying land today. They're actually actively working and building out their sites. So that's sort of where we're at. And you can sort of see the consumption side of things, right? As I mentioned, as real estate starts to slow down, sort of that wealth effect, consumption. I believe car sales slowed to basically, after 3 years of continuous growth, have basically flatlined. Consumer spending grew by 0.3%, which is its slowest pace since 2015. So that is starting to show up again in the data, and this really all comes down to credit, which has been decelerating as well, right? So these are all tied together, all these credit markets, right? And isn't it sort of somewhat ironic, I guess nobody really paints this whole picture together, is, as I mentioned, it really is about the bigger picture. It is about credit markets, how they function. It's not so much about what prices are doing on a month-to-month basis. You have to look at sort of the bigger picture, and that's going to give you your trend. Because looking at the average sales price, it's going to bounce around month to month. It doesn't really tell you anything. You have to look at the bigger picture to understand where you are in that cycle. And the reality of it is so many of these real estate segments or economies are actually so interlinked and intertwined because the credit markets are intertwined. Global capital flow, all these markets are now correlated. Money just moves around the global economy in such a way that all these markets are interconnected. So it's no coincidence that Vancouver real estate, Toronto real estate, the Australian housing market, Sweden, London, UK, All these real estate markets are in the midst of a slowdown. You can throw Manhattan there as well. All you have to do is simply go and Google it. Of course, documenting what's happening here in Canada. I get a lot of these people reaching out to me, sending me articles, etc. So, and the IMF, the International Monetary Fund, even put out a report stating, wow, look at how interconnected all these real estate markets, and they've highlighted some of the data to that. So again, looking at the bigger picture, yes, it's always nice to look at what's happening at a micro level, people talking about their neighborhood, this and that, and what's happening in that neighborhood. Maybe your one neighbor gets an over to the asking price offer, and you want to extrapolate and tell me, that your area is booming. I think again, you have to sort of step back and look at the bigger picture. So that'll be interesting to watch moving forward. Again, nobody truly understands or knows how these markets are going to react. But I certainly think that we've turned a corner, it seems like, in the condo space. Obviously, the detached market, I think, speaks for itself. So it'll be very interesting to watch moving forward. The Bank of Canada held rates earlier this week. They're still expected to move forward in July with another rate hike. Obviously, the inflation is still running a little bit hot, but I think this economic data is quite disappointing. I think with a continued slack in the Canadian housing market, I just don't see how the Bank of Canada can get overly far in their rate tightening cycle, which is extremely curious because looking at what's happening in the United States, I think they have a lot of reasons to hike interest rates, and they certainly seem intent on getting 4 hikes in this year. Unemployment there has dropped down to 3.9%, the lowest it's been since the year 2000. So I mean, that they're running at full capacity, so they're certainly going to move ahead, and Canada generally tends to follow in lockstep. So the Bank of Canada ultimately is going to face a decision here. They're either going to have to sacrifice households and household indebtedness, which is at ultimately extreme levels, or they're really going to have to sacrifice the Canadian dollar, because if they don't follow the Federal Reserve there, I think they're going to run into some issues. They're going to start importing some inflation there as well, and that's just going to hurt the Canadian dollar. So that'll be really interesting to see what they do there. A sort of a tidbit, right? I mean, there's a good economic paper from a couple of economists that was put out. They basically studied the 16 OECD advanced countries, and they basically found a correlation between these 16 countries that had the largest run-up in household debt prior to 2007, 2008. They had the longest run-up in household debt, or the largest run-up in household debt over like a 10-year span. And then coincidentally, from 2007 to 2009, their household consumption decreased or declined by the largest amount. So again, there's a direct correlation there between the run-up in debt and house prices, and obviously consumption is correlated with that, right? Everybody's out there spending money, feeling good, when your house is increasing in value by 20% every year. But all of a sudden, as you start to get into a deflationary environment, and all that wealth that maybe you thought you had starts to dry up or decline, you start pulling in spending, you start paying down debts. Again, that's not to say that anything is imminent here, but this is really understanding sort of the bigger picture of real estate cycles. These things do happen. I don't think it's anything to be overly concerned or worried about, but I always tell people it's sort of having a longer term perspective, right? I mean, I think Vancouver is going to be fine in the long run, but at the end of the day, you have real estate cycles and you can't avoid those. So it's really about understanding where we're at and what it means for you and your investment decision. Everybody is in a very different situation, so you have to take that information and apply it to yourself. All right, hope that helped. Talk to you soon.